Good morning. Welcome to our viewers around the world to this press briefing on the release of the Global Financial Stability Report. I am Randan Naggar of the IMF's Communications Department. Let me introduce our speakers today. Tobias Adrian, Financial Counselor and Director of the Monetary and Capital Markets Department, Fabio Natalucci, Deputy Director of the Monetary and Capital Markets Department, and Ranjit Singh, Assistant Director of the Monetary and Capital Markets Department. Before taking questions, let me kickstart our briefing today and turn to Tobias here and ask a few questions. Tobias, a lot has changed since the release of the GFSR in October. What is new at this time?
Yeah, thanks, Randa. A lot has changed since October. And the way I would put it is that the global financial system has been stress tested with two shocks. The first is a sharp increase in interest rates related to the tightening cycle of monetary policy around the world. The second is the adverse shock from the war in Ukraine, which has pushed commodity prices and food prices up and has adversely impacted supply chains further. For now, the global financial system this year has been able to absorb both of these shocks, but there are many risks and vulnerabilities going forward, and we'll certainly talk about them in a minute.
What is the one most important challenge that the global economy and central bankers are currently facing?
The single most important challenge of our time right now is inflation. Inflation is well above a target in the majority of countries around the world, and central banks have to act aggressively in order to bring inflation back down to target. There's a risk of de-anchoring of medium-term inflation expectations. So at the moment, we see that shorter-term inflation expectations are very elevated, but then there's a gradual expectation of inflation coming back to target in most countries around the world. However, there's a risk that eventually inflation expectations could de-anchor and there could be more of an expectation of inflation even in the medium term. Central banks have to counteract that by tightening monetary policy, slowing economic activity to bring inflation down.
Excellent, thank you. What is your advice to policymakers?
Yeah, I would say there are four main issues on the table right now. The first is bringing inflation back to target, so tightening monetary policy. That is the number one issue. The second issue is about regulations. We still have a number of areas of priorities for regulations. One is the non-bank financial intermediation sector. We have seen in 2020 in the Dash for Cash that there are many vulnerabilities that need to be fixed. The second one is the crypto ecosystem that needs to be regulated globally. And finally, there are emerging vulnerabilities in the current macroeconomic environment. So macroprudential policies are the appropriate tools here. Third, we have to create a global payment system that works together across countries, where CBDCs, central bank digital currencies, are interoperable across countries. They can operate together, and we need global cooperation to get to these payment systems. And then finally, we need a transition to a greener financial system. So that means better data, better disclosures, but also climate finance and climate stress testing. So these are the four priorities on the policy agenda from a financial stability point of view.
Thank you, Tobias. Now we turn to your questions, which you can submit via the online media briefing center or WebEx. For WebEx, we kindly ask you to raise your hand feature. We're going to start with the WebEx now. We start, please, with Greg Robb, MarketWatch. Greg? Okay, we move, while Greg is trying to connect, we go to Mao Ling from Xinhua. Mao Ling? Okay. There seems to be something wrong with our WebEx feed here. So let me turn to the Media Briefing Center, and then we go back to WebEx. We'll start with Lalitja, PTI. He's asking about bank holdings. Banks holding sovereign debt has increased significantly in India since the global financial crisis. What risk it poses to India's fiscal stability? What's the IMF's prescription to resolve it?
Yeah, thank you for that question. So in India, we have indeed seen an increase in sovereign debt as the government has deployed expansionary fiscal policies during the pandemic. We also saw an increase of holdings of banks of this sovereign debt. However, the fiscal situation in India is sustainable. Furthermore, the level of sovereign debt on the banks that we are seeing is also leaving us at comfort. So we are not alarmed at this point. Having said that, there are many other countries where we do worry about this interaction between sovereign risk and banking sector exposures, but India is not one of them. Perhaps, Ranjit, do you want to?
Yes, thanks very much. Thank you, Tobias. I think as Tobias has outlined, the situation in respect of India is certainly one that is manageable. I mean, in the context of the question, of course, the level of bank holdings of sovereign debt in India is actually at about 29%. And this is on average higher than the emerging market figure of 16%. And of course, India's public debt to GDP ratio is at about 87%. So in the context of the question that's being posed, I suppose, with the backdrop of the tightening in global financial conditions that Tobias had mentioned at the beginning, there is always the risk that this could trigger an adverse feedback loop between the sovereign and banking sectors, and through various channels. And I think the question, talks about some of these channels and what they are. And this again looks at situations where the higher sovereign borrowing rates could have an impact through the adverse impact on bank conditions, impacting the balance sheets. Tighter borrowing constraints could also have an impact in terms of government's ability to support the stressed banking sector. And these are the kind of issues and amplification channels which are actually quite extensively covered in Chapter 2 of the GFSR. And then the question really looks at what sort of policy sort of recommendations that could be made. I mean, these are, again, outlined in the report. They involve looking more closely at some of the risks that the sovereign bank nexus provides, being very vigilant to these risks. At the same time, we also recommend that banks should be subjecting, they should be having stress tests being conducted and against these amplification channels that I've outlined. And on a more sort of medium-term basis, there should be more efforts being placed in terms of addressing some of the issues which are associated with building a more deeper and diversified investor base. So these are some of the recommendations that we put forward in the chapter.
Thank you, Ranjit. We know now that WebEx is functioning well, so we go back to our WebEx questions. We start with Greg Robb. I see his hand raised. Greg, please go ahead.
Hi, this is Greg Robb from MarketWatch. Thanks for doing this. Tobias, could you talk about, there's a lot of people when you talk to them that the Fed has lost credibility in the markets. They think that either people think inflation is going to go too high and the Fed won't get it under control, or that the Fed won't be able to achieve what it wants, like a soft landing, and there'll be a recession. So has that shown up in financial markets? And if not, what should we be looking for to see if it does? Thanks.
Yeah, thank you. That's an excellent question. The Federal Reserve in the United States is facing a tremendous policy channel. Last year, coming out of the COVID pandemic, inflation was already elevated due to supply chain disruptions. Then this year, the war in Ukraine hit and inflationary pressures were increasing even more, there are more supply chain disruptions, there are higher commodity prices and higher food prices, so there are more inflationary pressure than what was previously expected. So when we look at the monetary policy in the US, we can see that policymakers have really tightened the forward guidance about the path of interest rates going forward. So the path that is priced into markets is much steeper and a much earlier tightening than what was priced in just a couple of months ago. We view this stance of monetary policy by the Federal Reserve as appropriate. And in our baseline forecast, we do have a softening of economic activity, which is the intended outcome of tighter monetary policy. But at the moment, we don't forecast a recession. Having said that, there are risks around that baseline. And if further adverse shocks are hitting, further supply shocks or further adverse shocks to real activity, certainly we could see worse outcomes than what is forecasted in the baseline. We are in an environment of high risk, and it is very important for the Federal Reserve to be data dependent and to be very clear in the communication about monetary policy going forward. Let me turn to Fabio to complement me.
So thanks, Rob, for the question. I think I will add a couple of things. So as Tobias mentioned, the risks to the inflation outlook are on the upside, not just in the US, but in a number of countries. We monitor closely risk related to the inflationary pressure becoming entrenched in inflation dynamics, as well as the possible de-anchoring of inflation expectation. So we look at like the TIPS markets or inflation-protected securities. There you would see the long-term inflation expectation or proxy for long-term inflation expectation have remained largely anchored at this point. We also look at other markets measure, for example, options. There I think you get a little bit more worrisome message. So right now the probability of inflation above 3% any year between now and the next 5 years is about 65% in the US, about 60% in Europe, and even higher in the UK, for example. So we try to take a broad view of inflation measure, inflation expectation measure. That's why I think it's important, as Tobias mentioned, that the central banks act decisively to bring inflation back to target in a credible way, and while at the same time avoiding a disorderly tightening of financial condition that may put the recovery at risk.
Thank you very much. We go to Mao-Ling now on WebEx.
Thank you, Randa, for taking my question. I have two questions. First, just to follow up on the Fed question. The report said central banks should avoid a disorderly tightening of financial conditions. So as the Fed signals that it will act more aggressively at its upcoming meetings, how likely is there a risk of disorder tightening, and what could be the implications for emerging markets? So the second question is about China. The report talks about highlighted financial stability risks in China and saying that extraordinary financial support measures may be necessary to ease the balance sheet pressure, but it would add to medium-term debt vulnerabilities. How does the IMF suggest that China can make efforts to strike a balance? Thank you.
Yeah, thank you for both of these insightful questions. So let me start with a question about the Federal Reserve. The intended consequence of monetary tightening is to get to a tightening of financial conditions that then slows down aggregate demand, slows down economic activity, which in turn brings down inflation. So some tightening of financial conditions is intended, but of course, you don't want a disorderly tightening of financial conditions. So disorderly is the kind of sell-off and dash for cash that we saw in March 2020 at the onset of the COVID pandemic. So yes, we want a tightening. We want tightening not just of monetary policy, so not just of interest rates, but also of broader financial conditions. But we will watch very closely to what extent that is an orderly tightening. And an orderly tightening, of course, would feed into an orderly slowdown of economic activity, which is what we're forecasting in the baseline, which would then bring down inflation back to target. it is extremely important to tighten monetary policy at this point in order to prevent an unmooring of inflation expectations. As Fabio has explained, at the moment, medium-term inflation expectations are well anchored, but of course there is a risk of de-anchoring. So there's a risk that expectations would move beyond the target level in a remarkable manner. That hasn't occurred, but it is a risk that needs to be addressed via a tightening of monetary policy. Let me go to the second question on China, and then also ask Fabio to complement me. So in China, we have two adverse shocks. One is the COVID situation, which requires lockdowns in many cities in China. And that is fueling further supply disruptions and potentially has an impact on aggregate demand and sentiment. The second shock, and one that had occurred already earlier, is the slowdown in the property sector. The property sector is a very important segment for both investment and consumption in China. And some of the biggest property developing companies in the world are in China, and many of them are in distress at the moment because of this slowdown of the property market. And that, in turn, can have macro consequences.
Yeah, so just to follow up on Tobias, so clearly we have seen, compared to the Global Financial Stability Report in October, an intensification of the pressure of tightening of conditions in the property development market. And a risk that liquidity risk, in fact, may turn into morph into credit risk. Some measures have been taken, for example, channeling funding to the healthier segment of the property developers, reduction in mortgage rates, access to availability of mortgages. Now, in addition to local measure, obviously, I think central government measure would actually be helpful. And I think the intent here is to avoid that the contagion goes beyond the real estate sector to the broader economy. The report identifies a number of channels. So liquidity risk in the property development sector may actually have implications for the broader real estate through declining house prices, declining sales, declines in land sales. That could also have implications for local government, for example, whose revenues rely heavily on land sales. Local government also have connections with corporates, local corporates, as well as with banks. So you can see easily how some of this macro financial feedback loop effect can actually go from one sector to the broader economy, including the financial sector. Now, the PBOC has taken some measures. Those are helpful measures. I think we should also consider broadening or stepping up use of fiscal policy, particularly measures that lessen the impact on household balance sheet as well as SMEs, so smaller firms, for example. And then ultimately, structural measures are also important, both in the real estate sector and the property developer sector, addressing some of the vulnerabilities there, as well as other structural measures in terms of deleveraging the financial system. Chinese authorities have taken a number of steps over the year to address these vulnerabilities. And then one last example, also investing in climate finance, so investment in green so that to help the decarbonization of the economy.
Thank you, Fabio. We still stay with WebEx. Eric Martin, I see you from Bloomberg raising your hand.
Yes, thank you very much. I wanted to ask about one of the risks highlighted in the report about the use of crypto currencies to evade sanctions on countries including Russia and Iran, and how much of a concern this is in terms of the financial stability risks that are out there. Thank you.
Yeah, thanks for that question. That's a very important topic, and it's a segment of financial markets that we're watching very closely. So the main challenge, of course, with using crypto assets to circumvent sanctions is that if you move money into crypto, at some point you have to get it out. And for that, you need a traditional financial institution eventually. So you need to get back into the banking system. And of course, the banks are subject to the sanctions. So putting money into crypto is one thing, but then getting it out is challenging. And so as a result, what we're seeing is indicative. There's no comprehensive data on crypto assets, but we do have a lot of evidence that is suggesting that there is relatively little activity at this point in terms of undermining sanctions via crypto assets. And there are in particular two main sources of evidence. One is price-based. So when you look at the kind of scarcity premium within Russia, there is not much of a premium there in order to go into Bitcoin or other crypto assets. So it's a very slight premium, but it's not very elevated in comparison to other countries. So it doesn't look like from a price-based approach, there is a scarcity of crypto assets in Russia. And then secondly, when we look at activity in Tether, which is one of the stable coins, there was a slight spike after the invasion of Ukraine, but the magnitude of the spike was not very large relative to the total economy. And since the early days, this spike has come down. And so stablecoin activity, from what we can see out of rubles into other currencies, is very limited. So our punchline is that the evidence to date suggests that there is not much going on in terms of undermining sanctions via crypto assets. But of course, it is something that we're watching very, very closely, and we will keep a watchful eye on it.
Thank you, Tobias. We still stay on WebEx, and after that we go to online questions. Delphine, I saw your hand raised earlier. You're still interested in asking? Delphine, AFP?
Sorry, you have already answered my question.
Oh, okay, excellent, thank you. So we'll go to the online questions now, and it's a focus a bit on emerging economies. We'll go for Ahram Online. There is a question from Doa Abdelmenem. What are the expected effects of the increase in global interest rates on developing economies, specifically on Egypt, considering that Egypt already increased interest rate by 1%?
Yeah, that's an excellent question. So let me start with the big picture first. And then perhaps turn to Ranjit to give a little bit more detail on Egypt in particular. So the big picture is that we are seeing a lot of differentiation across countries in terms of capital flows. So emerging markets are all subject to those pressures of tightening monetary policy globally. So interest rates are rising, financial conditions are tightening. But in terms of capital flows, we haven't seen a major risk-off event at this point. Rather, what we're seeing is that some emerging markets see outflows. China is one country where there are quite a bit of outflows of capital, but also emerging markets that are importers of commodities and food in particular. And this is, of course, the case for Egypt. Egypt is importing food, in particular wheat, specifically from Ukraine and Russia. So that is an adverse development for Egypt, which is putting inflationary pressures in the country and is putting pressures on capital flows. But we have seen other countries where capital has flown in. For example, Brazil has seen capital inflows recently, and Thailand has seen capital flows recently. So it's quite a bit of differentiation across countries. Commodity exporters have also seen capital inflows to a large extent. Egypt, unfortunately, is hit by these higher commodity and higher food prices. Ranjit, do you want to?
No, I think, Tobias, you've covered a lot of the key grounds in respect of the differentiation that we're seeing within emerging markets. And I think quite clearly, in the case of the question, really sort of alludes to the impact that the increase in global rates are going to have on developing economies. I mean, clearly there's going to be an effect on exchange rates, capital flows. Tobias has mentioned the capital flow effect that's happening already. And on top of that, you're also seeing, and that sort of pressure is essentially going to create more stress in terms of domestic yield curves and cost of funding domestically as well. I think compounding the challenges, of course, are these inflationary pressures that Tobias has alluded to, having an impact on emerging markets. And so the central banks in emerging markets are also facing the challenge of trying to contain the inflationary pressures, whilst at the same time ensuring that they continue to be able to manage the cross-border spillover effects that may may adversely impact in terms of growth. Now, coming to Egypt, of course, Egypt's economy is particularly exposed to these sort of pressures. And again, as Tobias pointed out, it has very large exposure in terms of its wheat imports. It's one of the world's largest wheat importers, with about 50 to 60% of its wheat coming from Russia and Ukraine. And clearly that's having an impact in terms of inflationary pressures in Egypt. And Egyptian spreads had already begun widening prior to the invasion, in fact, with high external financing needs, rising inflation, and limited fiscal space. So these are certainly having factors which are having a bearing on Egypt. So although Egypt has taken measures to stabilize its external accounts in recent weeks, including the devaluation of the Egyptian pound and the 100 basis point hike that the question alludes to, there are still significant concerns that certainly need to be managed.
Thank you very much, Ranjit. We'll stay on emerging economies and take one more question online. Yolanda Morales, El Economista newspaper. Mexico completed 2 sequential years with capital outflows, and since the beginning of the war, the investors sold more Mexican debt bonds. Can you please make some recommendations to the Mexican authorities to face this situation?
Yeah, thanks so much. And of course, Mexico is an exporter of both oil and other commodities, as well as of food. And so the impact of the war in Ukraine is relatively less pronounced on Mexico at the moment. Furthermore, Mexico was very early in terms of raising interest rates in the face of inflation, and it has done well in that respect as well. So I would characterize the situation as a fairly robust one. I do want to flag that there will be a regional press briefing as well on the Western Hemisphere, and specific questions on Mexico and other economies of the region can be answered in that context.
Thank you very much. We go back to WebEx, and I see Colby Smith wanted to ask a question. Colby?
Thank you so much. I was just curious if you could outline in any detail any of the potential fallout with the commodity market dislocation that we saw recently. If there was any kind of concern of private trading houses nursing losses that could potentially dent liquidity, and any other potential ramifications from that market event.
Yeah, let me give you the big picture and then pass to Fabio, who has looked into these questions in great detail. So I think the big picture is that conditions in commodity markets tightened tremendously as volatility shot up, prices of commodities shot up, and margins. When you have leveraged positions in those markets, you have to put up margin, and those margins increased tremendously as volatility increased. So there has been some distress, in particular the very well publicized event at the London Metals Exchange, where the nickel went to extremely high levels, and some participants were distressed. But more broadly, markets have generally functioned well. Now, having said that, it is a market that is very concentrated, and there are certainly regulatory and policy issues that will need to be addressed going forward.
So thank you for the question. So I think the report focuses primarily on 2 channels. One is the financing of commodities shipment, and the other one is the commodities derivative market. Right, so in the first case, we have seen a rising in shipping costs and increase in financing need of some of the trading energy companies. They need to finance their shipment. So that's one channel of stress, and where the disruption in commodity markets has impact on the financial system. The second channel is through derivatives market. So we have some of the producers, usually they try to hedge their position, and broker-dealer and dealer banks are at the center of the financial system. They are intermediaries there. And then you have a number of other participants. So we focus primarily in the report on the dealer banks' role. They play a significant role. Again, they provide financing, they play intermediation role in the derivatives markets, also provide leverage to some of these players. Another channel is through this, you mentioned the energy trading companies. So it's the concentration angle, if you want. So there's concentration both on the dealer bank side, so there's been a decrease of number of banks that play active globally in these markets, as well as on the derivative, as well as the commodities trading firms. There are a small number of those. They are relatively large. They are global. They are largely unregulated, and they're often private. So there's not much information to actually look into the exposure of the dealer banks to these players. And so those are primarily the channels that we are focused on. I think in terms of policy recommendation, we have a few calls there. One of them being to make sure that from the dealer bank side, that there is adequate disclosure as well as visibility in some of this position. And so in terms of capital position, as well as like margins availability when there are margin calls. And then also have visibility in terms of the global picture, I think, in terms of this market, right? So again, those are global banks, those are global energy trading firms. They are often unregulated. They often are private, and we have seen some pressure actually in the bond price of these firms. So reportedly reflecting concern about liquidity as well as credit at some of these energy firms.
Yeah, I think just to add on to Fabio's very comprehensive view in terms of where their issues are, I think at a broader level, just to follow on to a point that you made, Tobias, at the beginning, in terms of NBFI regulation, I think there has been a lot of attention, focus post-GFC on the financial derivative side of things. And I think there is a probably an opportune time now for a more closer look at the broader regulatory implications on the commodity space by market, financial regulators, etc. This is important. So aside from a few key jurisdictions where there has been this focus, I think there certainly is a lacuna which would benefit from a more closer look in terms of both the depth of regulation, the points that Fabio was making in terms of gaps there, the perimeter, and where there are the pockets of opacity which need to be addressed. So those, I think, are very important as well.
Thank you very much. We stay on WebEx. We have Simon Ateba raising his hand. Simon, please go ahead.
Yes, thank you for doing this, and thank you for taking my question. This is Simon Ateba with Today News Africa in Washington. I'm wondering if you can talk a little bit more about the Sub-Saharan African region in terms of financial stability risk. What are the main threats right now? Is it all the debt, the rising debt due to COVID-19 and all the loans that the IMF gave African nations in 2020 and 2021? Is it rising inflation due to food prices as a result of the war in Ukraine? And if you can also talk more about how all this will affect oil-producing countries like Nigeria, Angola, and even unstable countries like Ethiopia. Thank you.
Yeah, thanks for the question about Sub-Saharan Africa. So in the COVID pandemic, Sub-Saharan Africa was hit hard in terms of the level of output. The impact of the pandemic itself was perhaps less pronounced than in other parts of the world, but the economic impact was pronounced. And as the war in Ukraine hit, Sub-Saharan Africa was still in the recovery phase, so it had not made up all the losses that occurred during the COVID pandemic. As you allude to, an important policy lever for countries during the pandemic was to use fiscal spending. And so in many countries, we have seen an increase in sovereign debt. So looking across countries, one very important distinguishing feature is whether countries are commodity importers or commodity exporters. And there's certainly differentiation in the marketplace across those countries in terms of pricing in sovereign debt. So the spreads are very different for commodity importers and commodity exporters. That, I think, is one important differentiation. A second important differentiation is the level of public debt. A number of countries are in debt distress. They're working on restructuring their sovereign debt. And that, of course, is impacting their funding costs. But other countries are able to issue. So even relatively riskier issuers have come to the market in recent months and have issued in the frontier space. Finally, let me point out that a number of countries, about 20% of emerging markets and frontier economies in the world, are currently trading at basis points above 1,000. And so that's an indicative of the stress among this group of countries. The amplifying factor here, of course, are food imports. The fact that food is imported in the vast majority of sub-Saharan countries puts stress on public finances, and that is certainly a challenge going forward. Let me stop here.
Thank you. We still stay on WebEx, and we have MENA News Agency with a focus again on North Africa in this case, and he wants to ask about inflation. Mr. Mamoun, you can come in.
Hello, I am Ibrahim Mamoun from the East News Agency. I want to ask about the inflation. The crisis of inflation is not anymore related to a specific country. So after all countries should deal with the inflation debt and the different targets, how will the IMF deal with more than 100 countries, the most vulnerable countries, in dealing with the crisis if the prices still continues to rise?
Yes, that's an excellent question. And as you're pointing out, there is a scarcity of food in a number of countries. The extremely elevated food prices at the moment are putting a lot of stress on countries. The IMF is doing everything it can to help its membership. And we have the ability to provide rapid financing. So, for example, Egypt has obtained rapid financing. And there's also the ability to have more traditional IMF programs in order to help countries. So we are there to help the membership. And again, in the regional press briefings, there's a lot more depth on specific regions such as North Africa and what kind of programs are in progress.
Thank you, Tobias. I have received another question, actually online. It was submitted about the ECB. And do you think it is time for the ECB to raise rates, and how early can they do that? Thank you.
Well, in the euro area, inflation is also very elevated and notably above target at this point. This is particularly so because Europe is importing gas and oil from outside of Europe, in particular from Russia. And so energy prices have come up tremendously, as well as food prices. And that is impacting core inflation as well. So core inflation are the items in the consumption basket that are other than energy and food. And so these inflationary pressures are making a tighter stance of monetary policy necessary in Europe. The European Central Bank is on the path to tighten, and that is via a normalization of balance sheet policies. This is already in progress, and there could eventually be increases in interest rates as well, though it's too early to say at what point that would be appropriate. The monetary policy continues to need to be very data dependent. You know, we are in an environment with a lot of uncertainty, and there's the negative supply shock through commodity and food prices, but there's also a slowdown of real activity due to the war in Ukraine. And so monetary policy needs to communicate well to markets about its intention going forward, and has to be very much data dependent. Fabio, do you want to?
Just a couple of thoughts. So the ECB, the Fed, has initiated the process of normalization of policy. So they're slowing down asset purchases. They have indicated that they will, sometime after the end of that, start thinking about raising the policy rate. They've communicated that they intend to do this in sequences. So they're communicating the sequence of this, and they also tend to be flexible. So they're going to be data dependent based on how the economy is going to progress and how inflationary pressure will progress. Now, one risk that they will be paying close attention is the risk of fragmentation in some sense and the transmission of monetary policy. We have seen some spread widening in Southern European countries once the ECB has initiated the normalization process. So at this point, it's important to be data dependent, act decisively, and again, avoid fragmentation within the Eurozone.
Thank you. We have one last question before we wrap. Bukulo Eduo from Nigeria. I think he has his hand raised on WebEx.
Good afternoon. My name is Bukola Eduo from Leadership Newspaper in Nigeria. My question is concerning Nigeria. Our inflation rate in the country has been trending upwards in recent times, and the central bank is seemingly adamant on raising interest rates, benchmark rates. What policies are you looking at? Do you think can be prioritized in controlling inflation in the country? And also, is the IMF concerned about the rising debt in the country? Thank you.
Yeah, thanks so much for this question. And Nigeria is, of course, both an oil exporter, but also an importer of refined oil. So on net, it doesn't benefit as much from the rise in commodity prices and oil prices in particular because of this dual nature of being both an exporter of raw oil but an importer of refined oil. So the net impact is one of inflationary pressures. And as you point out, the central bank has moved towards tightening monetary policy and there are other challenges, of course, in Nigeria which need to be addressed as well.
Thank you very much. We're going to be wrapping up now, so let me thank our speakers, Tobias, Fabio, and Ranjit. Also, thanks to our viewers who joined us today. We would like to remind you that of the release of the Fiscal Monitor tomorrow, 7 a.m. morning DC time. Thank you.